Right, learners, another adjustment that you're going to come across that can get a bit confusing is when they talk about capitalizing interest. Now, if it's capitalized, it means that the interest is added onto the capital amount. Now, that capital amount that they're referring to could be your loan, the capital amount that you borrowed, and the interest would be added onto it. Or it could be the capital amount of your investment, a fixed deposit, in which case the interest is also added onto it. So let's just look back here first of all. If your interest is not capitalized, now please take note, I'm saying it is not capitalized. In other words, that on your loan, the interest is charged to you separately. So you will have your loan account and you'll have your interest separately. So you've got your loan account, and this loan account over here of 100,000 over here is your liability on the credit side. The bank charges you interest, and interest being an expense would be a debit. And in this case, remember I'm saying it is not capitalized, and if they tell you that this interest is still owing, you then put through an entry expenses payable or expenses accrued, which would go into your trade and other payables in your balance sheet as an amount still owing. Now just compare that. If we go here and we look at the case where they tell you that your interest is capitalized. Again, you've got your loan of 100,000. But now the bank is charging you interest of 12%. So still your interest of 12,000, nothing different there. But in the case of it being capitalized, it adds on to your loan. And so the amount of the loan is now 112,000. And as you move into the next year, when they start charging you interest, you're going to be charged interest on the 112,000. So the interest is actually going to go up every year because you start getting charged interest on your interest. This is what we refer to as compound interest. And in maths, you would have done this, where you start paying interest on your interest. And then when you pay off, obviously you're paying off an amount, so it'll go onto the debit side because you're reducing your loan. But that 10,000 is coming off the capital plus the loan. So now just have a look now. If they tell you that your interest is capitalized, you add it onto the debt of the loan. If it is not capitalized and you haven't paid it, it adds onto another debt account called the expenses payable. The difference is here that next year when they start charging interest, the interest is only charged on the 100,000. Or this is simple interest. This is where you are charging interest at a flat rate of 12% every year on the capital amount. And so when you're paying off, obviously, yes, you'd pay off the capital portion of your loan, which would go on the debit side of the loan account, and then you pay off this interest here. So you'd pay these things off separately. In reality, most banks will be charging you on a compound interest on a capitalizing. Now, the same applies to your fixed deposit. You've got a fixed deposit of 50,000, an asset. You are earning interest on that. So, your interest income, which is an income to you, so it'll be on the credit side. And that income, if it's still owing to you, would go to income receivable or accrued income, money owing to you. If you have already received it, you would debit your bank account. On the other hand, if you're capitalizing it, what happens there is that you will be receiving interest. And so the interest that you're receiving, the same amount of 3,000 as I had before, still goes to your income account, interest income. But if it is capitalized, what it's doing is telling you to capitalize, add it back onto the fixed deposit. So the amount invested in your fixed deposit is now 53,000. And as long as you don't take any of this money out, you will now start earning interest on 53,000. Again, it's using compound interest, where you start earning interest on your interest. If it wasn't compound, then you would be receiving that interest. You would not be reinvesting it into the bank. You're keeping your fixed deposit at the same amount. Now, please, as I said to you with the loan, it is normal for most loans to be capitalized. Likewise with your fixed deposit, it really depends on what you're wanting. Whether you want to earn that money and get it every single month, then it'll be paid into your bank account, or if you are investing for growth, it'll be reinvested, and that increases your fixed deposit. So you need to read very carefully whether they're telling you to capitalize or not capitalize.